So let's talk more about the big picture here for earnings, what it means for the markets right here as people are eyeing this big week ahead. To be more specific here, we've got more banks reporting Tuesday as well. Bank of America, Goldman Sachs. We've got airlines on tap, United and Alaska Airlines. And finally, two big ones in tech as well. Tesla and Netflix are going to be reporting after the bell on Wednesday. A big theme in last quarter's results, warnings of a consumer slowdown. Should we expect to see that play out this quarter as well? For more on this, we now turn to Shana Orczyk Sissel, who's the CEO of Banrion Capital Management. Shana, thanks so much for being here. So we're looking, as I mentioned, consumer discretionary stocks are actually doing well today. They're helping lead the gains. How are we feeling going into earnings season about what earnings are going to tell us about the sustainability of the consumer in particular?
Well, you pointed out last quarter, a lot of companies warned that the consumer was stretched. We've seen some rise in debt and debt to drive spending with mostly lower end and middle class consumers. It will be interesting to see how that plays out in this earnings cycle if they continue to remark that the consumer is stretched. Inflation in particular, food inflation and the cost of gasoline is a major headwind for consumers in general. So like you said, it would be interesting to see how that plays out as, overall earnings estimates is for growth going into 2024, 12% growth to be exact. And I'm not sure, I find that a little too optimistic personally. I do think the consumer is starting to feel stretched, but it might be another quarter before we see that really come out in the numbers as student loan repayments really gets into gear and other stressors really put pressure on the consumer.
And Shana, earnings on deck, but I'm sure you heard, I was talking to Julie right before we brought you on about another issue that investors are trying to work through, which is new geopolitical risk, war between Israel and Hamas. Right now, it seems like investors are placing the bet this stays contained. It doesn't spill over, it stays limited. I'm just curious how you as an investor are thinking, Shana, about that risk.
I'm actually more concerned than the market seems to be. It doesn't seem like we're making much progress here. And we do have an issue here with, the negotiation of the other side. Hamas itself is fragmented and not necessarily working in the best interest of the Palestinians. But that's a conversation for another time. I think between the war between Ukraine and Russia and this is an escalating tensions globally, and the Middle East is a hot spot that we should be concerned about. There are several other countries that are impacted by this, and the Saudi-Israel normalization has been put on hold for their relationship because of what's going on there. I think the market is shrugging this off as no big deal, when maybe they should be considering that this is a bigger deal than they are thinking.
And do what about that, Shana? We were talking about people pulling back on this traditional havens today, like gold, like treasuries. Do you think that's a mistake? Should people be, doing some hedging trades here?
Well, I personally use a lot of liquid alternatives as diversifiers to kind of make my portfolio more defensive. So those are things like BTAL and MRSK, if I'm talking ETFs. FMF is another one that we use. I'm looking more at those types of uncorrelated ways to provide diversification to a portfolio versus, those traditional safe havens of gold and treasuries, which, in the treasury market, there's the Fed aspect of it that is influencing the pricing and the yields there. And, gold has its own kind of supply-demand issues. So for me, I'm trying to be less correlated to traditional markets, and things like FMF, MRSK, and BTAL provide that kind of diversification for our clients. So I'm more in favor of using those kind of investments as a defensive way to posture the portfolio versus, the traditional safe havens that are out there.
And Shana, given all these very powerful cross currents you're mentioning here, so Fed, geopolitical risk, we have earnings on deck. What's your general view of the equity markets, Shana, right now?
I think they're holding up quite well. The economy is showing to continue to be hotter than expected. Labor markets remain tight. Inflation remains sticky high. And as long as that continues, that's going to be a headwind to equities because we're always going to have the Fed as a concern. Now, there have been many Fed members and governors who have indicated that the Fed is done raising rates and they really want to see how this kind of plays out, which I think is smart. But we don't want to get into a 1970s scenario where there's a lot of stop and go. The question really remains, is the Fed, when they say 2%, do they mean 2% or do they mean sub 3? Because the long-term average over the last 40 years for inflation is about 2.8%. So I think the realistic target should be, if they can get inflation under 3%, that would be a win. And that is what I would consider as the best scenario for a soft landing. They're not really communicating well, if that's what they're looking for. And I think that's really a risk, because inflation does appear to be sticky high, and there's really nothing in the growth numbers that are indicating that growth is slowing down, which is what we would really need to kind of get supply and demand back into equilibrium. Until that happens, I'm concerned that there is downside in this market.
So let's get to some of your other investment ideas, right? You mentioned some of the liquid alts and the ETFs that you're playing them through. I was struck by your choice of Nvidia also in your stock picks, because if we're looking at a market that is on a little bit of delicate footing right now, and as we know, Nvidia has been almost a rocket ship on this AI thesis, doesn't it get hit along with other growth stocks if things start to go south a little bit?
That's certainly a risk, and I'm not saying I'm a huge fan of technology here. Nvidia is kind of a special case, in my opinion. I followed this stock my entire career, so 20 plus years. And I just think that there's not a lot of competition for what they provide. They have a very strong balance sheet. They have substantial cash, reserves much higher than their debt. And quite frankly, this AI tailwind is not going to stop just because the economy slows down. It might, be somewhat slower, but Nvidia will continue to benefit as they are the largest provider of chips in that space. They lead that space. They really don't have any competition there. And so for that reason, I think Nvidia can actually hold up quite well. If it did, for any reason, start to turn down, I would be a buyer of the stock. I continue to hold the stock. And I think that it is a stock that actually will, of the technology names, ride through this period quite well. The AI trend is not going away, and Nvidia is the largest beneficiary of that particular trend. So for me, it's still a stock that I hold. It's a stock I would buy more of on weakness. I just think the long-term trend is very favorable for them in particular, and that is not saying that I'm a huge fan of technology as a sector, but that stock in particular, I think, has a lot of tailwinds and will continue to do well regardless of economic conditions.
All right, we'll be watching. Shana Orczyk Sissel, thank you so much for joining us today, Shana.
Thank you.